Today we will go through the discussions of the audit failure of one of the largest telecommunication company in the United States during the 1990s, which is WorldCom. In a telecommunication company, line costs are fundamental expenses to keep the company operating as they are associated with carrying a voice phone call or data transmissions from the call origins to its destinations. Hence, it is inevitable that they constitute a major part of its expenses. With the end of the wave of mergers and downturns in the telecom industry, the senior management resorted to fraudulent accounting methods to disguise its decreasing earnings to maintain the WorldCom stock price. The fraud was accomplished in two ways. One, the inappropriate accruals released from year 1999 to 2000, followed by the capitalizations of line costs in year 2001 to early 2002. The accruals were supposed to reflect estimates of the line costs which WorldCom had not yet paid, and release of accrual was considered proper only if the bill turned out to be lesser than anticipated. The improper release of accruals had led to the reductions of line costs by approximately $3.3 billion. By capitalizing costs, which were operating expenses, WorldCom has shifted those costs from the income statement to the balance sheet, resulting in an increase of reported pre-tax and earnings per share. Earnings were inflated by more than $3.8 billion. How could anybody overlook a $3.8 shell game? The sheer amount of money involved accentuates the audit failure by the company's longtime accountant, which is Arthur Adamson. Should the external auditor order attentions perform their work properly, the fraud would not have prolonged for years. The failure of the audit was due to the following reasons to be elaborated.
Generally speaking, Arthur Anderson gave WorldCom a low audit risk with a subsequently high materiality level and declared no necessary further action was required. Improper review and auditing techniques were carried out by Anderson. A major flaw in their approach was that they overlooked the documentations and controls that were exploited by WorldCom finance personnel. Anderson therefore had failed to detect fraud on accounting irregularity due in part to negligence and in part to the tight control top management kept over information. WorldCom exerted excessive control over Anderson's access to information, as well as the access to the computerized general ledgers that caused a difficulty for Anderson to perform its duties. Anderson had determined that it should perform certain procedures, including the testing of controls and substantive tests relating to a number of audit areas where there were higher risks of error, fraud, or failure. However, it appeared that Anderson's testing had significant flaws. For instance, they reviewed the processes and controls relating to capital expenditures, using small samples to test the effectiveness of controls over the accounting of construction. Such an approach could be effective only if all entries to fixed assets were made through the company's normal purchasing process, but that was not the case. Moreover, in testing the controls in place relating to line costs and the calculation of expenses and related to accruals, Anderson appeared to have reviewed only domestic line costs and not the ones attributed to the WorldCom Group or the international divisions. It seemed to me that the fraud could have been stopped dead in its tracks if Anderson had been doing its job properly as planned before. And in order to prevent similar incidents from occurring, Anderson should have done more to follow up the red flags by either growing suspicious of any unusual transaction or acquisitions, or not completely relying on the information received from the internal management.
The next factor will be the lack of communication between Arthur Anderson and Audit Committee. Firstly, Arthur Anderson did not communicate its specific risk assessment to the Audit Committee. In the Audit Committee meeting, there were limited description of area carrying greater audit risks with assurance. Secondly, they faced difficulty in their performance of audit for WorldCom as they were restricted access to information and denied requests to interview with employees. Despite these difficulties, Anderson failed to bring this problem to the attention of Audit Committee. Should they have informed earlier? Audit Committee will be able to enforce management to allow them access so that Anderson will be able to identify problems within the company. Thirdly, they had identified areas of improvement in WorldCom control. However, this was not communicated to the Audit Committee as well. An example was one of WorldCom division unable to bill certain account aggregating significant amount because of billing issue relating to unbillable call. Moreover, Anderson had identified numerous weaknesses in WorldCom internal control, even detected and supported journal entry to the ledger of their UK subsidiary that was not corrected prior to the issuance of financial statement. Once again, Anderson failed to inform about such finding. Instead, they provided misstated document to the audit committee describing that there were no material weaknesses in WorldCom internal control. The absence of such communication raises troubling questions as to whether Anderson has properly conducted its audit for WorldCom in the past year in accordance with generally accepted auditing standards. I think that Anderson should communicate all findings with attached sufficient and relevant document directly to the audit committee.
Another contributing factor is Anderson's close relationship with WorldCom, which compromised the principles of independence and objectivity. Anderson has served as WorldCom's independent auditor for at least a decade, which explains their close long-term relationship. As WorldCom was one of the leaders in the telecom industry, Anderson viewed it prestigious being its auditor, describing WorldCom as a flagship client and a crown jewel. Unfortunately, the retention was largely due to the consulting revenue, which diverted their focus into earning profits. Hence, they spent more time selling those consulting services and less time conducting analytical and testing controls. This situation created a conflict of interest because the auditors would first consult a company about how to increase performance or efficiency and then return to the same company and independently audit it. This portrays a self-review threat, which is one of the threats to independence. Anderson was denied access to information and interviews which were necessary to conduct an appropriate audit. It appears that their relationship with WorldCom was more valued than the performance of appropriate audit work. Therefore, instead of overcoming those obstacles and informing audit committee of the difficulties, they audited without sufficient appropriate audit evidence for fear of losing the business relationship with WorldCom. In addition, David Myers, a former controller at WorldCom, stated that Anderson may not have overlooked the details intentionally, but rather were pressured to complete the auditing task as soon as they could. The desire to maintain close relationship with WorldCom has hampered Anderson's professional skepticism, the questioning attitude an auditor must have when in the field. In light of this, Anderson should have persevered in the investigations instead of allowing their relationship with WorldCom hinders audit performance. Instead, the priority should be putting the public interest first and not act with the purpose of material gain to bias their audit opinions.